Hello and welcome. My name is Chris Can with Mining News and Mining Journal, and with me I have Michael Scantlebury, who is a resource analyst with Euroz Hartleys. Today we're looking at the brokerage's corporate all-in cost metric and the trends the metric is throwing out. Welcome, Michael. Thanks for joining us.
Thanks, Chris. Thanks for having me.
So we've obviously got the all-in sustaining cost as the industry benchmark in the gold sector. Why have a corporate all-in cost?
Yes, what we're really trying to do here. So first of all, the all-in sustaining cost is set out by the World Gold Council, and what we're trying to do with the corporate all-in cost is truly just capture all costs in the gold sector, because you'll see a number of companies reporting an all-in sustaining cost. And quite often these companies are having weakening balance sheets quarter after quarter, cash outflows, and it's not truly capturing all the costs. So something with the corporate all-in costs, it'll really just, the only thing that it excludes is capital on new production centres, and then it accounts for dividends and equity issues as well. So it's just truly getting an idea of the cash generation of these gold producers.
Okay, and my understanding is you most recently published in February, around mid-February.
Yep.
What kind of trends are you seeing in the short term there, just going kind of month on month or quarter on quarter in terms of how you're reporting?
Yep. So the short-term trends is just really showing up this, which there's no real surprises. The cost inflation of the gold sector, especially in Western Australia, where you've probably seen over the last 2 years, the longer-term trend is cost inflation. These margins are really shrinking. It's outpacing the gold price in Australian dollar terms, which is near record highs. But this cash generation and margin squeeze is getting really tough in the sector. So in the December quarter, we saw only 10 Australian gold producers out of the 18 truly actually generating proper positive cash flow. So it's quite tough despite a very strong Australian dollar gold price.
When you're using this particular metric, what are the real pain points you're seeing in that inflationary environment that the miners are struggling with?
Yeah, I mean, it's just the cost of inputs, whether it's cyanide, explosives, and then just general wage inflation as well. We've got the iron ore miners that a lot of these gold juniors compete with for labour. So we're seeing a lot of those kind of cost pressures all flow through. And obviously at the fuel price, I know it's come back recently, but that diesel price is a large input, especially on these larger high strip ratio mines. And it's probably just worth touching on as well. You got cost inflation, but productivity of the gold sector has been dropping away as well. The skilled labour shortage, again, going back to it's a large mining industry in Western Australia, which comes as no surprise, but limited talent pool as well. So just getting quality labour has been an issue for some of these smaller gold producers. It's really hurt productivity, and you just have to look at the number of downgrades from production guidance set out at the earlier of the year, quarter after quarter. A number of these gold producers are really struggling to hit their numbers.
I think you've probably touched on a few of the points that I'm going to ask about next, Michael. But since you've started doing this study, working with this metric, what are some of the longer term trends that you're seeing coming through the gold sector? And for you guys at Euroz Hartleys, how does that point to the direction for the sector in the next maybe 2-3 years?
Sure. Yeah. So as we've talked about, that margin squeeze has been going on for some time over the last call it 18 months. It's really squeezing the margins as cost pressures outpace the increase in the gold price. But what we're seeing with our corporate all-in cost measure is really those lower true lower cost gold operations that generally outperform over time. And then, you can see that just in share price return when inclusive of dividends. It's quite unfair to look at it in a quarter by quarter basis as a number of mines have one-off tax payments or just capex on some of these satellite pits that they managed to bring online to extend their mine lives. But when you take it over a 12-month period, it kind of just truly highlights the total cost of these operations in the gold sector.
Michael Scantlebury with Euroz Hartleys, thanks very much for your time.
Thanks, Chris. Thanks for having me.